Hello, and welcome to Portfolio Matters, investment lessons of 2023. And I'm afraid there were a lot of them, as the market taught us a lot of lessons. But before we go through it, Stuart will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The views of any guests we may have on the show are entirely their own and may not be representative of the views of Portfolio Matters. A full disclaimer can be found at the end.
Thank you, Stuart. So, unfortunately, Richard has unretired, which means that he has a job and is quite difficult to pin down. So Stuart and I are going to record our lessons, and then I will add in Richard's lessons separately. Now, my lessons first, and this year taught me a lot. So going through, first of all, sanctions don't work anymore. The US has overplayed its hand, and when Russia invaded Ukraine and sanctions were imposed on Russia, the expectations, certainly my expectations, were that it would lead to some effect on the oil market, that Russia would find it difficult to export all its oil, because it could certainly export some of the oil via pipeline to China, but the rest would have to go by sea, and sanctions would make that difficult as Western tanker fleets were essentially stopped from transporting Russian oil. Didn't happen. Instead, essentially, there seems to be very little effect whatsoever on countries that choose to transport Russian oil. So India, as you can see here, has bought all the oil that used to be bought by the EU. So the net change in Russian oil exports over the period is zero. And what I find amazing is that the tanker fleet has just changed. There is still a portion, about 30% of oil, which is still being transported by EU or G7 tankers. And there seem to be no sanctions on those actors. But also the whole tanker fleet has adapted, and tankers which once were owned by members of the G7, now owned by third parties very happy to transport Russian oil. And everywhere around the world, supply chains have changed and Russian oil is simply being rebranded. So this is Chinese exports of Malaysian oil. Malaysia doesn't produce this much oil. When I was talking earlier about countries transporting Russian oil, I'm amazed by how many of these countries are nominally allies of the US. So the UAE hosts American air bases. Greece, member of NATO. There seem to be no consequences for transporting Russian oil and breaking US sanctions. I'm reminded that when Britain was a global superpower, we once sent the gunboats in when a British citizen had his ear chopped off, and we decided to send the gunboats in to teach the small country involved a lesson. So here, the UAE is transporting 30 million barrels of Russian crude and no consequences. And meanwhile, Germany is exporting loads of its capital goods to Kyrgyzstan, and I assume those are just leaking over the border into Russia. Meanwhile, the sanctions regime and the confiscation of Russia's US Treasury bills means that there is a growing number of countries which are resentful of US hegemony, and the BRICS has expanded now to include Brazil, South Africa, Egypt, Saudi Arabia, and Iran. And so you have now this big non-aligned bloc who are acting as a counterbalance to the US and presumably not buying US Treasury bonds. So all of that means that US sanctions just don't work very well. You can't stop Russia from exporting oil and by implication anyone else, like Iran. Their sanctions by the US are increasingly ineffective. Supply chains using this BRICS Plus group have just rearranged themselves. And that means that sanctions will only cause a brief spike in the oil price, but also that the US's dominance of the global financial system, in particular, the fact that everyone used to have to buy US treasuries as their reserves, is increasingly under threat. You're seeing that China and Russia have been buying gold instead of US treasuries, which potentially means that US treasury yields will have to rise as there's no guaranteed buyers. Stuart, your thoughts?
Yeah, a few observations. Three things I was going to say. Firstly, just pick up on your historical point. I think you can only sort of enforce this sort of thing when you're a totally dominant power. And I'm reminded of my own sort of O-level history lessons where the fascist countries in the 20s and 30s were sanctioned by the League of Nations, and it made not a whit of difference. You have to have, you've got to plug every hole in the sieve, otherwise, the water gets through.
Yeah.
So it's very difficult, which I guess is why the US has actually applied that price cap rather than the volume cap, because it knows that India is going to buy where it's cheapest, and as is China. So they've tried to suppress Russian revenues, and fingers crossed it has some effect. It certainly gives the Chinese very good leverage, but it's not really stopping the flow of money. The second thing I was going to mention was, well, what other sanctions are going on at the moment? And what springs to mind, of course, is the US restrictions on chip exports to China. And we've already seen the response of Chinese entrepreneurialism and creativity, creating what they can out of what products they've got. And of course, it'll be a spur to further creativity. And I think a creativity which isn't really motivated by money. It's motivated by national security.
Yeah.
And so in a sense, money is no object. And if that means building chip fab plants where the error rate would be unacceptable in the West, well, they're just going to suck it up because they want the volume of chips per se. And the third thing I was going to pick up on is, you sort of talked about it already, Keith, but is the finance angle of sanctions, that this sort of thing works if you don't use it very often. If you're blocking access not just to really to the financial system via things like SWIFT, the payment system, that can be very effective. But you keep doing it, and of course people are going to set up alternative systems, which I believe is one objective that Russia has, to set up a different payment system that doesn't touch any US banks.
Yeah. Thanks, Stuart. Okay. Point 2, monetary policy can take a very, very long time to work. Now, this has cost me a lot of money, and I got this totally wrong. So my theory was that interest rates in the US and frankly around the world have rose incredibly quickly in 2022 and 2023. So the blue line here is the Fed funds rate. The green line is the San Francisco Fed's proxy funds rate, which measures actual interest rates as charged to businesses and consumers in the economy. And you can see the Fed funds proxy rate went from minus 25 basis points in 2021 to 7%. Now, I expected, frankly, that to kill the economy stone dead, in part because private sector debt has just kept on rising. So my thought was, interest rates have risen by 7%. They act on 17 trillion of US private debt outstanding. That spiked up the funding costs, diverting money which would be spent on demand into servicing your debts, and that kills the economy. And frankly, that seemed to be what was happening. So if we go back to the start of 2023, global indicators then looked awful. So global leading indicators then, the red and blue lines, are heading straight back down, very consistent with recessions. If you look at the red line, it's only been that low during deep recessions, 2001, 2008. The Conference Board leading indicator in the US, this is going back to December 2022, already indicating the US should be in recession. And Morgan Stanley forecasting that US earnings growth is going to collapse in 2023. This is from the podcast in January last year. And everywhere you looked, people were forecasting recession. So these are the latest GDP forecasts as of the end of last year, forecasting recession by the second quarter of 2023. But none of that actually happened. Instead, by Q3, the US economy was expanding at an absolutely astonishing 4.9% annualized, and that was revised down from the initial estimate of 5.2. So that rise in interest rates just didn't kill the economy. Now, the thing is, we are now at the position where there are two possible outcomes. Either monetary policy is simply no longer effective, or the lags are much longer than I had assumed. Now, I am very much in the camp that the lags are much longer than I assumed. And you can see from this chart that the spending patterns from the start of Fed rate hikes, that actually not much happens for 2 years. Now, I think that's rather pessimistic. I think 1 year to 2 years is what most commentators expect to be the period in which interest rates have most effect. But interest rates didn't really start rising until about April last year, so we're about 18 months in. And interest rates should now be starting to work. So what I missed was that it's not just interest rates. What matters is the maturity profile of the debts. So in the US, what's happened over the last few decades is that mortgages have increasingly become 30-year fixed. So the main debt of US citizens just is totally immune to rises in interest rates. Also, during the pandemic, a lot of businesses locked in long-term, low interest rate debt. And so what matters is when that rise in interest rates starts to impact consumers and businesses. And the bottom line is, by increasing the maturity of their debts, the US economy and the British economy have all become less sensitive to rises in interest rates. And also, interest rates not the only variable in the economy. What caused the US economy to be stronger than anticipated last year was a big increase in the US fiscal deficit that nobody was forecasting. Bear in mind, the US economy was doing quite well, and so therefore the deficit should have been shrinking. Instead, it rose by 3.2%, supporting the economy, in part due to Biden's CHIPS and IRA acts. Stuart, your thoughts?
Well, I do think that's going to be very important for next year. The change in the fiscal deficit is presumably mathematically it just has to be contractionary. The other thing, which I don't really have my mind properly around, is just, well, if interest rates are going to go up, that's going to affect people who need capital. But in the modern economy, do services, and in particular tech, need capital, or that they generate enough for themselves that they're self-funding? And perhaps it's a very lopsided effect from rising interest rates. It hits perhaps manufacturing or other areas that need capital, but perhaps that area of the economy is shrinking and shrinking.
Well, the thing is, Stuart, the way the typical recession always worked was that it affected the manufacturing and construction sectors first. Construction in particular, because construction is, big capital projects which need funding. And if interest rates go from 0 to 7%, then suddenly the rate at which you're being charged for your new apartment block has gone from what, let's say 3 to 10%. And so people just stop investing in new capital construction. And that means construction industry slows, construction industry starts to lose jobs. As those people lose their jobs, they cut down on spending, and that cascades through the rest of the economy. Now, what we have seen this year, and has been astonishing, is that US construction has been absolutely fine. And I still don't understand that, frankly. Part of it is undoubtedly due to the CHIPS and IRA Act, where you see manufacturing construction has has
Mm,
grown enormously over the
yeah.
last year. But residential construction has not collapsed in the way I expected it to.
Yes, yeah, it's very difficult to know the proportions within an economy, and I think you've also mentioned on the show about residential construction of apartment buildings being that that's a bit of a pig in the python, and
Mm.
that's about to fall off a cliff as existing projects are completed and no one continues with that. Given that GDP requires a sort of year-over-year change,
Mm.
the CHIPS and IRA acts, perhaps it was all very front-end loaded, and in terms of year-on-year effect, that will come through in 24 and 25.
Well, I think that's right, Stuart, but so far that hasn't happened. The other thing I'd mention is that I increasingly think the US economy is very financialized. And what I mean by that is that 60% of the population owns stocks. And as long as the stock market's going up, they retain their animal spirits and they keep on spending. And actually, it might take a stock market crash to get them to pull in their heels, cool their heels.
Yeah, I always wonder about that. That I can imagine, a person of modest means, yes, they own stocks via their pension fund, but
Mm.
it's going to be reasonably modest effect on them, and how lopsided wealth is in the US, and how little difference that would make to the consumption of the very wealthy. I'm skeptical of.
True, true. So the investment implications of that is forecasting the start of this recession is very difficult. It's not just a function of interest rates. So before investing on the basis that there's going to be a coming recession, wait until there's indications in the real economy of a coming recession and be prepared to change your mind if the economy shows unexpected resilience. Because the reality is, last year, what did seem to be slowing into recession, but then it bounced and I didn't react.
It's very difficult though, because unless you are ahead, then surely it's all going to be priced in.
Yeah.
I mean, waiting for it seemed like you had waited for the moment of imminent recession. All those leading indicators were very, very
Yeah.
clear.
Yeah, no, I agree. And that brings us on to the structure of the mortgage market, to me, dictates how sensitive the economy is to interest rates because the biggest debts most people have are their mortgages. And in the US, where you've got 30-year mortgages, that means that people are not sensitive to changes in interest rates on their main debt. And that means essentially it's people with large credit card bills and student debt bills, etc., who then have to bear the brunt. And that means that interest rates have to move much higher than they otherwise would do because only a small section of the economy is sensitive to interest rates. And so you have to slow those areas of the economy which are sensitive to interest rates much more than if the broad mass of the economy was sensitive to interest rates. So we showed you this right back last year. And this is my co-host, Stuart Owen's mortgage bill, which went from £560 a month. We're talking about in October 22, which is well before the peak in interest rates, to 1,750. And we were forecasting on the back of this and the expectation that the similar rises are going to be happening throughout the UK economy, that rising interest rates would rapidly slow the UK economy. Didn't yet. Now, what's happened in the UK is that variable rates used to be the vast majority of mortgages, and now actually it's short term, 2 to 5 years. You'll notice there is very little long-term debt, and variable rate mortgages are now only about 10% of the market. Australia has 90% variable mortgages. So you'd expect Australia to be much more sensitive to a rise in interest rates. US and France, less so. So this chart shows which countries are going to be most sensitive to changes in mortgage rates based on what proportion of households have variable mortgage rates. Pause, take a look. So the investment implications of that are that the UK and the EU economies are going to be more sensitive to changes in interest rates than is the US. And that seems to be what's happened. For nobody knows anything, particularly me. So if we go through everyone's forecast for 2023, what a depressing load of bad judgment and bad forecasts they are. So recessions, everyone was forecasting recession at the beginning of the year. The yield curve, i.e. bond markets, predicting a recession, and they have been the most accurate recession indicator, as everyone was saying. Well, it's over a year now, and there's still no recession. This is Nordea's US GDP model. They're forecasting a deep recession in the US by Q4. Didn't happen. Even CEOs in the US, they were forecasting their own earnings would collapse. They didn't. This is Bloomberg. 75% of the UK recession in 2023. The UK economy is just barely avoiding recession. The US economy, they've got 65%. It grew substantially. Deutsche Bank, 100% probability of a US recession. Conference board leader, you get the idea. Inflation. Now, inflation's really interesting because everyone underestimated how high inflation would get. And then they overestimated how long it would persist. So Citigroup forecast, this one from February, they forecast that UK inflation was already peaking. It didn't peak for a while yet. And then it would come down very rapidly so that it would be pretty much bang on target by 2% by the end of this year, i.e. now. The ECB, this shows the systemic bias in forecasts. You're always forecasting that it's going to come down quickly towards trend. UK shows exactly the same pattern.
I take it Richard produced these charts, did he?
Fed,
yeah.
Economists, this is actual UK and EU recession, got much higher than everyone forecast and then has come down much faster. Same with the US. A big takeaway for me in the inflationary episodes, wait until inflation has peaked because everyone is going to be too early in forecasting the peak in inflation. And then when inflation goes past their forecasts, they're going to think that inflation will last forever. And actually, it doesn't, because modern economies are incredibly flexible. And it seems the vast majority of the inflation we experienced was due to supply shocks and not an increase in demand. Stuart, your thoughts?
It says something about the nature of knowledge, isn't it? And the dismal science. What can you know? When inflation started to rise, we all said, "Oh, look, this proves monetarism was correct, and printing money has caused inflation." Now, oh no, well maybe it was just a supply thing, and it's working its way through the system. But the impact that's had in markets is so dramatic. And there was a fantastic quote I think, by John Plender in the FT, which, if you've got a second, I'll just read out,
Sure.
because it's talking about the market reaction through the year. And he says, the key to understanding these extreme swings in sentiment is to be found in the mechanics of data-dependent monetary policy. This causes investors to revise and re-revise endlessly their trading strategies based on intense parsing of central bank rhetoric and on expectations of how aging incoming data of variable quality will influence central bankers' rate setting. And that's what we have, isn't it?
Yeah.
It's like criminology, where we're looking at every word, every phrase, every change by the Fed, and very big movements in markets that occur based on that. The move down in the 10-year rate in the US from just above 5 to just below 4, that was incredibly quick. And
It was,
that's
but
actually my difficulty in terms of, you talk about, well, look, don't predict, wait for it, and then join the bandwagon. But by the time I'm convinced of it, we're 2/3 of the way through the effect in markets, and I don't want to jump in that late when so much has already happened.
actually raise a really good point there, Stuart. I mean, when it comes to criminology, I mean, that's largely what we do on this podcast. We are following the data very closely. But what really struck me about this year was just how volatile markets were. Because when I got killed this year, it was in August and September when bond markets across the world sold off hard. Now, the reality is, during that period, inflation had peaked and was coming down quite sharply. It's just what happened was there were some strong US growth numbers, and the market seemed to discount the possibility that interest rates just weren't working, slowing down the US economy. And so interest rates would just stay higher for a very long time. And that move was just completely unexpected. And bond yields went much higher than I could possibly have imagined in a few weeks. And that move has largely unwound. Now, way I've got caught out this time is that normally my strategy is when I think equities are overvalued, I sell them, I move to cash, and I sit and I wait for something to happen. And then I buy equities, oil stocks when they've crashed, and they're incredibly volatile, and at some stage they crash. And people always underestimate the optionality of holding cash. And actually, what this year has taught me is the optionality of holding cash is really good when markets are this high. If I had been sitting on cash, I could have bought bonds at what I considered ludicrous levels. Because to me, the challenge for us as private investors going forwards is to try and retain the wealth we have got from the rise in markets from QE to very high levels. Now, not everyone can be rich, but we've all done incredibly well out of the stock market the last 20 years, 15 years on the back of QE and very low interest rates. And to me, when interest rates rise, asset prices should go back down. Now, they haven't. That doesn't mean they won't. And the thing about bond yields at these levels, it means that actually, if you were to switch into bonds and lock in inflation plus, you could preserve your wealth. But I just don't think we can all preserve these inflated asset values when interest rates have risen so much, because asset prices have shot up on low interest rates. Surely they should come back down if we're having higher interest rates. What are your thoughts?
Well, very broadly, I agree with you, though I do think the overvaluation is very lopsided. Obviously, US equities and property, I think, are the two asset classes that have been most inflated. I think there are pockets of reasonable value in ex-US equities. And also, I think I was on the program 2 or 3 months ago, and we were talking, I think, about index linked. And that had prompted me to look at the US and just, my goodness, US tips were at 2.5% real.
Yeah.
So based on exactly the same logic that you're talking about, my goodness, that's enough to preserve your purchasing power. Thank you very much. I actually bought some at the time, but unfortunately only a very, very small amount. But as a very sort of 30,000 foot observation, I think you're spot on that we should be thinking, look, there's been, quite a big bubble here, or a very strong rise. It will be crazy to expect anything similar over the next sort of 10, 15 years. So strategically, it's about protection, not about big profits. Though having said that, I don't think you need to be just in fixed income. I think there are other areas where you can protect yourself.
To be clear, I was trying to be counter-cyclical and it hasn't turned. I'm not holding bonds for long term.
No.
No. Well, but holding bonds, because normally my game is I sell equities, I move to cash, and I wait until equities have bombed out and then I buy them again. This time, I thought I'm going to be really clever and I'm going to be counter-cyclical. And instead of just waiting in cash, as the economy's slow, long bonds do really well. I'll buy some long bonds. And of course, it hasn't worked out. Do I think that I've been thinking about this a lot, obviously. Was it a bad strategy? I don't think it was, actually. I just think that I need to apply in both directions the sitting in cash and waiting until things get extreme.
Well, you say that, but I wonder whether the other possible interpretation is that you should put your position on more slowly and in more modest size.
Yeah, that would require a change of character.
Ah, got it.
Stuart.
Okay.
Yeah, but I'm incapable of that. Oil. So everyone was forecasting that by Q4 2023, the oil market would be in deficit to the tune of 2 million barrels a day, and everyone was super bullish on oil. Well, if that didn't happen, this is the IEA, going to have deficits from Q3, 2 million barrels a day by Q4. That would have sent the oil market flying. Of course, actually, nothing like that happened. The oil price, despite tensions in the Middle East, actually has done nothing all year. Corporate earnings forecast to slow and fall with the economy. This is the forecast as of the start of the year. Margins were expected to fall. You get the message. Bottom line, forecasting is really difficult. Try to do as little of it as possible. Going forwards, this is my big takeaway. I'm going to try and be much less predictive and much more reactive. I'm going to try and react to extreme prices, of which, this year we saw a huge sell-off in bonds that actually, if you timed correctly, we could have made a lot of money out of. Not yet a big crash in equities, but, in my career in the investing over the last 35 years, crashes come along very regularly. You just need to be there to hoover them up. And actually, this made me feel a bit better. So this is the FT Unhedged. This is their portfolio, their dream portfolio at the start of 2023, and what actually happened. So their portfolio would have lost 67%. So I was bad. But another lesson was, I think, commodity bubbles are very strongly mean reverting. And this is of great relevance to what's happening in uranium right now. So reminder, 2021 to 2022, lithium went stratospheric. went from 50,000 to 600,000. And reminder, the commentary then was the growth in EVs was going to lead to enormous demand in lithium, and there wasn't enough lithium. We didn't, reserves, etc., etc., etc. Well, we went looking for lithium and we found loads of it. Neodymium, rare earth, they're needed for all the wind farms around the world. The price, what's that, quadrupled, comes straight back down. Rhodium, actually, that is an absolutely astonishing. That's more than a tenfold. That's like a 15-fold rise. Straight back down again. Vanadium, this is a while ago, but shot back up in 2019. Shot straight back down. Natural gas. I mean, this is a really good example of what goes on. So Russia invades Ukraine, shuts off the pipeline. We shut off the pipelines, importing Russian gas into Europe. We then import LNG from around the world. Now, you would think that is going to be much less efficient because we actually have to outbid like Asia, and there's not that, the supply chains are much longer, and it's much more energy intensive, frankly, to import LNG from Australia or Qatar. But if you look at the natural gas price, it is right back down again. Supply chains are extremely flexible. And when properly incentivized, humanity is very good at finding the necessary commodities. So I was listening to a podcast during the week where somebody was saying that they have never seen a shortage not followed by a glut. They have seen gluts that are not followed by shortages. And so when we look at all those charts, commodity bubbles seem to last, I'd say, a minimum of 2 years, but a maximum of about 3. So there is time to get into a rising trend, but don't get carried away by the rhetoric and think, actually, there's going to be a shortage forever, because there's not. Stuart?
Well, it reminds me of the Shoeshine Boys story. I remember I was at my tennis club a couple of years ago, and some people were asking me whether they should get into lithium. But
Yeah.
by the time it's filtered down to the retail punter, it's probably
Yeah.
the ninth innings, as the Americans would say. The other thing I think is that you've got to know what you know what you don't know. There are so many persuasive stories about commodities that come and go through the years, and a little knowledge can totally be a dangerous thing here. I think it's better to tell, unless you know the industry, unless you actually genuinely know what you're talking about, it's better to give everything a wide berth. I wouldn't be with you trying to time a swing in and a swing out. For me, I'm just stepping aside. It's not my game. I don't know what I'm talking about.
Well, I try and do it, Stuart, but I try and do it when the margin of safety is very much in my favor.
Mm-hmm.
So, we think about what happened in the pandemic. So when oil prices, remember, WTI went negative.
Yeah.
So then oil demand collapsed, and Shell, whose share price I know and memorized because I bought so much Shell. So going into the pandemic, the share price of Shell was around 23, 24 pounds. And when it fell in a straight line at £13.50, I started buying it. It kept on falling. I bought it at 12, 11, 10. Last tranche I bought was at 9. Okay. So when it gets to 9, I'm down I'm about down 35% on the first tranche, actually more than that. And I'm not looking very clever. But then it bounced and I sold the whole lot at what, 22? Because the world needs energy. Things are going to normalize. But you have to buy them At £13.50, I thought the odds were very much in my favour. What I didn't realise was how low it was going to get.
Well, I think you did very well on the averaging. That's I mean, if you
Yeah,
decide what your ultimate position size is and divide it up into those smaller chunks, that I think you did the right technique of getting in.
yeah. Well, the bottom line is, though, at the end, you are holding quite a lot of risk. If it
Mm.
goes down to 8, you are really suffering. Now, and related to that, momentum strategies would have been the best way to play volatility in the current environment where nobody knows anything. So the secret fund manager, who doesn't appear on this because he's got a job, um, he made 25% last year by playing uranium. And, that's the chart of uranium. As of last week, it shot up another $9 to over 100 now. You know, but look at what happened last time. That is my prediction of what's going to happen this time, by the way, Stuart. But there was plenty of time to get in, actually. I was deeply skeptical about this, as I covered on the podcast, as the trend developed. And I shouldn't have been so skeptical because I've been hearing bullish things about uranium for the last decade. But, you know,
I can just see myself though. Look at that chart. Goes from 25 to 50, and then it's bobbling around. I would have sold then. That to me would have looked like it had reached, some plateau, and I'd be
yeah.
looking back at the chart, thinking, "Oh, you can create so many patterns in your mind when you're doing it just on a chart on momentum basis." For me, I'm stepping away. I've got no skill in this.
Well, the thing is, Stuart, if you'd taken a 50, I think you'd have been quite happy.
Mm.
You don't have to get the top. And also, you just sell it in tranches.
Well, we need Richard and his opinion on what he's going to do with his holdings there.
Well, absolutely. So this is the US 30 year. You know, again, when things trend in these current markets, the trend gets really carried away much further than you could possibly think. I mean, when we go back to those commodity charts of lithium and rhodium in particular, very small market, prices get really pushed. And it does make me wonder whether there's a systematic lack of liquidity.
Well, that makes total sense. I mean, obviously, we know a lot of hedge funds are momentum based, but
Yeah.
their definitions of momentum get very esoteric. And I think if you're going to be doing it for yourself, then you need to be very clear about what your stop loss is.
Yeah. So, and obviously the Magnificent Seven, these are amazing charts. This is Nvidia, Microsoft, Amazon, Meta, which amazes me. Um, so going forwards, my plan in the weekly is frankly when I think that there are some momentum trades just developing, I'm going to put in a section on momentum trades. I personally think uranium's getting a bit long in the tooth when everyone's talking about it. So anyway,
Well, Keith, on that point, I believe there are some ETFs that are synthetic replicators of hedge fund strategies. You can get momentum-based ETFs, which are not just equities momentum, but across different asset classes.
very good point, Stuart. There are actually, and I should cover those at some stage. Now, the other thing that happened this year was we had a big financial crisis.
Mm.
We've just forgotten about it. So earlier in the year, I showed this chart where basically every time interest rates have risen this quickly, you put a lot of stress on the financial system and particularly highly indebted entities, and inevitably something breaks. Well, this year it did break. So we had the failures of Silicon Valley Bank, Signature Bank, and Silvergate Bank when essentially they were caught out by their mark-to-market losses on their bond portfolio. And the contagion then spread to Credit Suisse, which collapsed because of a lack of market confidence in it. So at that point, there was a bit of a panic in the financial markets. Equity sold off, bond yields fell, financial conditions tightened, and depositors withdrew their money from banks. And the general fear was that we were going to have a systemic financial crisis, but we didn't. Instead, what the Fed did was it created the Bank Term Funding Program, which allowed US banks to borrow directly from the Fed at a 10 basis point premium to the 1-year swap. And crucially, they could borrow the full face value of the bonds they deposited as security rather than their market value. And that allowed US banks to access liquidity. So they didn't have to go to a skeptical and dysfunctional funding market to fund themselves. They could go straight to the Fed. They also gave emollient words, and that was enough, actually. So this financial conditions tightening after Silicon Valley Bank, and it was a big year. So Silicon Valley Bank and Signature Bank were the second and third largest bank failures in US history. And we've kind of forgotten that. And then subsequently, First Republic Bank was even bigger. It's the second largest bank failure in the world, in the US history, sorry. And as a result, US depositors were fearful and running to money market funds, which had higher yields. And the fears that depositors had were justified. So the unrealized gains that US banks had on their securities portfolios are absolutely enormous. But there was no contagion. There was no wider financial crisis. The market actually probably bottomed at that point and rose for the rest of the year. And as conditions stabilized, so depositors started putting their money back. So what this taught me was that we're always fighting the last war. And the great financial crisis was very traumatic. But since then, regulators have imposed lots of rules on banks to make them more, to stop their previous misbehavior and make them much less leveraged. As a result, the danger of a systemic crisis is lower. And they've also become adept at doing whatever it takes to prevent a systemic crisis. They have learned from Lehman. So bottom line, it seems that financial panics in future may actually be a good buying opportunity, not for the banks themselves necessarily, but for the wider market, because central banks will do whatever it takes to stop another Lehman. Any comments, Stuart?
Well, the Puritan in me still finds it sort of slightly blood boiling that these banks can behave in an irresponsible way, and that there is a degree of literal bailout here, that the managers walk away with their historic salaries and bonuses, and they've behaved in a very imprudent way. I do wish that they had more skin in the game of literal share ownership that they had bought themselves, rather than share options, for instance, and non-clawbackable bonuses. Because there is, of course, a fear that every time the problem is solved via more liquidity from central banks, that yes, we have prevented a crisis in the here and now, but have we stored up something worse for the future? And I do think that having more skin in the game would cause just more generally prudent, old-fashioned behaviour by managers.
Well, I agree with you. I mean, I remember Fred Goodwin, after the failure of RBS, just walking away with a £700,000 a year pension.
Absolutely.
Well, everyone else, suffered huge losses. I think we should reinstigate the old Italian punishments for failed bankers from the Middle Ages.
Oh, what was that then?
That was death. Not many banks went bust in Genoa when there was a death penalty.
So the other thing I was going to add on this, back to the modern day, is what this means for private credit. The regulations on banks and their own lending is, of course, pushing a lot of lending to happen in the private space. And I suspect some of this could actually be quite clever, quite useful credit. But by the time it filters down to you and me and any retail product, I suspect that we'd be getting the dross. But it could be that there's further look, risk is not being reduced, it's just being transformed, it's being shuffled off into other holders. Though it does seem to me to make sense for private credit to be extended because it will be much less leveraged than a bank at 9 or 10 to 1. If it KKR doing some sort of private lending at a 2 to 1 leverage, that seems inherently more prudent.
Well, on that note, the other thing that happened this year was in the bailout of Credit Suisse, $17 billion of AT1s, which, on your point, were created to spread risks around the financial system. They were written off to zero. What AT1s are you're meant to be bailed in to the capital structure of the bank if the bank needed capital. And the Swiss regulator essentially wrote these things straight off. So it's in essence confiscated $17 billion of investor money in order to prop up Credit Suisse so that as a dowry for UBS. So another lesson of the year would be that actually regulators will privilege the stability of the financial system against private rights in these sort of bonds, which they'd previously been encouraging. Volatility has been extraordinary. This is the Nasdaq Composite, 20% in 2 months, just amazing. And really, what is up, 56% on the year or something?
Well, Keith, it's just efficient markets discounting the likely cash flows into the future, surely.
Yeah. I wish I would, I pray at the god of rational markets, but he seems to be missing in action at the moment. The S&P 500 up 16% in 2 months. Russell 2000, just amazing. The volatility in equities, astonishing. And then obviously we had this huge sell-off in US Treasury bonds between August and November. That's a 1% rise in the yield on the 30-year. So that equates to pretty much a 20% drop, a 25% drop in the price. Volatility creates opportunity, basically. Cash gives you optionality. If you are nimble, you can get in and out and take advantage of these big moves. But, I've just found the volatility this year incredible.
Keith, there's been so much volatility, as you've just shown, except in the volatility index.
Yes, I know.
It's extraordinary. Against all my instincts, I couldn't resist putting on a little CFD trade on the VIX index, which we've talked about before. It's the road to ruin. It shouldn't be done, and I shouldn't have done it. A bit like your S&P trade when the VIX fell, you were betting against the S&P, thinking it must fall. I've just done it in microscopic size because I couldn't believe that the VIX was 14, but then it went to 13, and then it went to 12.
Yeah, no, absolutely. I know. Number 9, and frankly, I'm slightly preempting Stuart here, but big is beautiful. Now, something Stuart is going to be talking about is the work of Henrik Bessembinder, and he looked at performance of US companies over the period 1926 to 1929, and he found that essentially half the gain in wealth from the stock market came from the top 1% of listed companies. And if you look at the performance of the UK, the FTSE 100 at the top here, and this is performance essentially since I've got data for all the series, and that turns out to be 2002. But over that period, FTSE 100 has returned 230%. The 250 has returned 50%. The small caps have actually done better, up 150%. And the AIM all share, the very small companies not quite mature enough to get onto the London Stock Exchange, they've returned minus 14% over the course of 22 years. And if we look at the total return index, now I only have the total return index for the 100 and the 250, actually the performance is much more in line. So the 100 returned 134% since 2012. The FTSE 250 has returned 107. So actually what that's saying is a lot of the returns from the mid caps comes from dividends. If we look at the US, we see a similar pattern. So the NASDAQ 100 since 2008 has returned 960%. The NASDAQ Composite has returned 656%. And this S&P 500, 414. So basically, in the UK and the US, don't invest in the small caps. All the returns come from the big caps. Investing in small caps is fun, but investing in large caps are much more remunerative. What Bessin Binder found was that the vast majority of the companies on the stock market make no money at all. They appear, they disappoint, and then they get delisted. And actually, you want to invest in that small, the 1% who create long-term value. Stuart, I'll leave you to talk about it in your turn when it comes to your turn. And finally, number 10. This is the most important section. Drinking is good for you. Every week on the weekly, we cover good news, and this is the best news imaginable. So, a German hospital surveyed 628 over 60s. That is rapidly approaching for yours truly. And everyone's always telling you to cut down on drinking, but the third of the people they questioned who were drinking unhealthy quantities of alcohol, they were the happiest. They were more social, they were slimmer, happier, and more mobile than those who drank less or were teetotal. Incontrovertible evidence that drinking is good for you. And on that note, Stuart.
Well, just to say that is clear evidence of why you must attend the next Portfolio Matters booze night.
Yes, exactly.
Right. Okay, so my lessons. Of course, there will be quite a bit of overlap with the points that Keith has been making, but just to highlight this, Bernard Baruch, the main purpose of the stock market is to make fools of as many men as possible.
Yes.
I was one of those fools.
Yes, well.
We've sort of covered this, but that there wasn't a recession despite all the statistical evidence suggesting there really had to be. Nothing broke. Well, we've covered the regional banks, which turned out to be a blip. And it was the year, I mean, you can have some sympathy for Nvidia, but crypto also to the moon. So I've got a chart here of ARK ETF, Cathy Wood's thing. You can see that the big fall in 22, but over 23, you actually sort of made, I think, 60, 70%. It's not for me, but there you go. That's markets, and I was not in tune with the mood of the moment. Talking of what has made money, talking of Nvidia, etc. Here's a brief section more systematically about wealth creation in the US stock market and how often it is actually these large companies that disproportionately create wealth for owners. So this is going to be a very brief summary of the work by Bessin Binder from Arizona State University, where he has created a measure of shareholder wealth, which is increase in capitalization plus dividends. So that is not necessarily share price performance. You could be a small company whose shares go up a lot, but if you haven't created wealth for broad distribution via an increase in capitalization, then it's a bit of a different measure, if you see what I mean. But his point is, for the overall market, wealth creation is concentrated in relatively few high-performing stocks. And he also says that this degree of concentration has increased over time. And obviously we can think of the recent tech boom as being an example of that. Now, just to give some added context, when Baillie Gifford, a famous UK growth manager, saw this report, they thought, aha, this proves why we should be investing in Tesla and Bitcoin, etc. We want those few golden tickets to the future. They asked Besson-Binder to repeat this analysis for non-US markets. And I haven't included that here for brevity reasons. But basically, it came out with very similar, even if not even stronger conclusions for non-US markets. So getting on to some of the detail here. So in his analysis of the US market from 1926 to 2019, only 42% of stocks beat T-bills when you measured it via total wealth creation. 58% of stocks didn't beat T-bills.
Wow.
And he says over 26 to 2019, only just 5 firms accounted for a whopping 12% of the overall wealth creation from the stock market. And 83% of firms were responsible for 50% of wealth creation. So this really is a massive power law example where very small percentage of companies created a wildly disproportionate share of this measure of total wealth creation, i.e. increase in capitalization plus dividends. So here's the list here, where top of the list is Apple, which created 1.6 trillion of wealth, which was 3.5% of the total wealth creation of the US stock market. Second was Microsoft. Third was ExxonMobil. Now, the very fact that these names are all so recent led me to think, well, hold on. There is a little distortion here, which is that he's created a measure of shareholder wealth creation, which is in nominal dollars. So if you were some tech company in the 1920s and you had gone up from $100 million then to $300 million, you'd tripled. But in his measure, you've only created $200 million of ultimate lifetime wealth creation. So I began to be a little bit skeptical of what he's actually produced here. However, he's got a fantastic table later in the report, if you skip on, Keith. Now, this is impossible for you to read on the screen here. It's too small, but the report is available for free on the internet. And what this table shows is within each 3-year period, what percent of firms were responsible for what percent of wealth creation. So this, I think, removes my objection about the nominal dollars. So in the first year, 1929, there were 760 firms in his database, and only 0.26% of those firms were responsible for 10% of the overall wealth creation from the stock market. And it took only 2.6% of those total number of firms to be responsible for 50% of the overall stock market wealth creation. So that's an example of one 3-year period. But if you run your eye down all the subsequent 3-year periods, that was not at all exceptional. And on average, his calculations suggest that 10% of gross wealth creation comes from just 0.12% of firms. So again, it's this very, very lopsided source of return.
Sorry, Stuart, can I just come in there? Because isn't there the problem with this is that because he's looking at absolute numbers, so absolute numbers of wealth creation, then by definition, he's going to have a size bias. Because if we say that there's a very small company that, pentuples in a year, its profits pentuple, it actually makes, a lot of money. and its share price, pentuples as well, it contributes nothing to wealth creation because it's so small.
Yes.
Whereas if a large cap company creates 10% wealth, then it disproportionately appears in this table.
That's right, which is why I was highlighting that his measure, shareholder wealth creation, is the
Yeah.
increase in capitalization plus dividends. It's not share price performance.
Yeah.
So I think it's very, very good to point that out, because it is a different measure from what we're used to. It's not, for instance, a small cap index versus a large cap index.
Yeah.
So one question that arises from Besson-Bider's research is, well, do you buy an index tracking fund? Because then you know you're going to get at least a bit of these super performers. Or are you Bailey Gifford and you try to pick those winners? And of course, philosophically, I think we can fall each side of the line on that.
In the weekly, I've got this section coming up on the performance of the NASDAQ 100 versus the NASDAQ Composite and the S&P 500. And it seems that over any period that you measure it, the NASDAQ 100 has beaten the other indices, but it is more volatile.
Mm-hmm.
So when there's a tech crash, it did really badly. But then when it bounced, it did much better. So going forwards, I really take the Besson-Bider's conclusion that you want to be picking the winners. That if you're picking small caps, you're just buying lots of lottery tickets, and you will get the occasional winner. But just like in the lottery, your expected return is negative.
Yeah.
And there will be some people who do very well, but the broad majority of people will lose money by investing in small caps.
Yeah, I
Relative
saw
to
some
big
recent research looking at commodity stocks and small commodity stocks and biotech, and it was actually exactly that same conclusion. You're in a lottery where it's biased against you.
Yeah.
It's fantastic stories for some new drug compound, but the odds are against you.
Yeah.
Right, moving on. So lessons, well, somewhat flippantly, but nihilism. No one knows nothing.
Yeah.
But it does also make me ponder about interest rates. We've spoken about this earlier, but what does rising interest rates actually do to a real economy? Do services and tech really care if they generate their own capital and they're a large part of the economy? They're responsible for the growth. But we covered this before with Keith's point about construction.
Well, actually, to come in there, Stuart, that house builders were affected. On both sides of the Atlantic, house builders have cut back on the amount of house building they're doing. What's been surprising is how little house prices have moved. So it seems that they have cut back their supply in order to maintain prices. And also, we're talking about the lags involved. One thing that is supporting the businesses of house builders on both sides of the Atlantic is that they have these historic land banks that they have yet to fully exploit, that they bought when prices were cheaper. So again, that's just another further lag in the system.
The other thing I've been thinking about is, well, look, if we've increased rates and it didn't crash the economy, did we need the opposite? Did we need zero rates after the GFC? Perhaps all that did was perhaps encourage financial speculation and didn't do anything for the real economy.
Absolutely.
And I suppose the point about nihilism is, well, perhaps the best thing you should do is buy a global equity index and go away, which is what I did for my kids, and they've done very well. Thank you very much.
Yeah, I know. Well, my daughter's set up a SIP for my daughter, and she shows no interest in investing whatsoever. So she's put it all in gold, which is
Right.
absolutely fine.
Another lesson, cynicism, and this is really just for ages we heard higher for longer, and we had this analogy with the tabletop mountain that the rates were going to stay higher for longer. But then in the last 6 weeks of the year, Fed hold rates steady, but indicates 3 cuts coming in 2024. But I think Richard would agree that central banks are forms of politicians, and they will adjust to the current mood of the markets and mood of society. So, yeah, I mean, you can't complain. You're in markets. Markets are there to give prices, and people are going to be changing their opinion every day. But I think from a private investor's point of view, a healthy degree of cynicism is absolutely vital.
Yeah. Well, be reactive rather than predictive, I think, actually.
Now, the big question for me is, am I being resolute or am I being just stubborn? And I'm talking here about US equities, because my biggest bet, and the one which has hurt me the most, is that I've got a reasonable amount of non-US equities, and I've got very little of US equities, including of tech. So that's been wrong and badly wrong. And the reason for it is essentially valuation. I show here in the chart the famous Shiller PE ratio, which compares the price to 10-year average inflation-adjusted earnings for the US market. And look, to me, this is just screaming. We're at a higher level than before the Wall Street crash. How can I buy these companies? And in the 20s, of course, there was all the excitement about electricity, radio. They had their own boom tech stocks. To me, I just can't touch it. But I'm also conscious that I've been wrong. And to repeat an expression I used before, am I dressing in the fashion of my youth? When I first came into investment markets, I was reading a lot about valuation anomalies in the stock market, a valuation tilt being the way to outperform. And I'm sort of sticking with that. But I've been so wrong.
Well, I'm completely agree with you, Stuart, in that, to me, the run up in the Shiller PE ratio, as interest rates went to essentially zero and QE, that was kind of rational. So, but when interest rates then rise very quickly, you expect the PE ratio to collapse again. And that hasn't happened. So, like you, I have always been very skeptical about buying into what I consider to be investment fads, such as, I mean, I know that AI is an important new technology, but the history of new technologies is that everyone gets way too excited and they take between 10 and 20 years to become really useful and integrated into the world economy. And this goes right back to the railway booms of the 1840s, through the Great Depression and the excitement about radio, to the tech.com bubble of 2000. Now, you and I were both, investment professionals at that point, and I personally, thought that valuations had got completely out of hand by 1996, and I sold all my equities in 1996 and refused to buy, any of these tech stocks. And as we know, they just went ballistic over the next couple of years, peaking in 2000. But to me, when these things collapse, they collapse incredibly quickly, actually. And I've, having chosen not to get in, I think you just stay out. I'm staying out.
Well, the next couple of charts is exactly my reason for continuing to be stubborn. We've just talked about the Shiller PE ratio. So price to earnings. Well, I'm also concerned about the level of earnings themselves. This is one chart which, perhaps in somewhat exaggeratedly, suggests that earnings are well above a historic trend in the US. This is the blue line is reported earnings. The dotted line is an attempt to regress through those earnings to create some sort of trend. But we've also, I think you mentioned in the weekly, Keith, there's some strong evidence that earnings themselves have been juiced by low interest rates, by tax cuts, and by increasingly oligopolistic behavior, if I've mangled that word not too badly. You were referring, I think, to increased industry concentration, allowing forms of price gouging.
Yeah.
So this isn't particularly a timely point, but I do worry about social backlash. And that's the point of the second chart here, which is one of these measures of asset inequality. And you can see here the asset value, the asset ownership value of the top 1% versus the bottom 50%. And it's continued to increase very painfully ever since even something like Occupy Wall Street. Now, that leads me on.
So actually, Stuart, can I just comment?
Yeah.
Because I would add a further point to your point about earnings being just way above trend, as you can see from the chart on the left. The Kalecki-Levy model shows that corporate profits are a function of the fiscal deficits. And we know that fiscal deficits on both sides of the Atlantic have shot up post-pandemic and refused to come down. And they're currently unsustainable. And what you can see in the chart on the left is that the rise in corporate profits last year, I think, was a function of the increase in the US fiscal deficit last year. Now, at some stage, the fiscal deficit has to start coming under control. And then that chart starts coming back to more normal levels. And the big concern for the economy and corporate earnings is that we are currently living way beyond our means. And so we're kind of, the fiscal deficit is giving the whole economy a sugar rush. And at some stage, we have to, be more sensible, but that will mean years of kind of grinding austerity.
Very good point. Very good point. That I'd forgotten about that driver of corporate earnings, but it's massively important, isn't it? Yeah.
Yeah.
So just on the risk of a social backlash and what that might do to asset owners and the stock market in particular, there's a very interesting book called End Times by Peter Turchin. Now, I did history at university. I'm somewhat reluctant to believe there really are predictable cycles in human societies. I think there's a real risk of sort of fitting, but it's worth considering. And this guy, Peter Turchin, he's fascinating. He was born in the USSR, as it was then, and he's a biologist. He's a professor at the University of Connecticut. And what he's done is try statistically to apply the same techniques to human societies as to insect populations.
Wow.
To their rise and fall, a sort of you're exploiting resources, and then, oh goodness, you can't sustain yourself anymore. So he's applying these quantitative complexity approaches to human society. And he's looking at cycles of what he calls political integration and disintegration. And he sees the elite capturing a wealth pump, which leads them to gradually exploit the rest of the population who suffer from stagnating or declining real wages. So the elite at the moment would be the corporate and private equity industry, senior corporate officers and the private equity industry, which, if you believe that they are in control of the pump and they're pumping the wealth from that to themselves, that obviously leads to wealth inequality and to exploding debt, as everyone else has to use debt to keep consumption going. But he argues that in particular there is elite overproduction. And this is where not enough people can get into the elite. And so those people who miss out, they become the people who undermine the system. So this could be, for instance, priests, educated priests who don't believe in the ancien regime in France, and they become one of the biggest underminers of a structure. The other big group, of course, is lawyers, particularly if they can't get their share of the cake. And we all know what's happened in, for instance, the US at the moment, with so many people going to university, so many people taking on big debt on the hope that they're going to get into the top crust, but there's not enough room at the inn. So his argument is that this reaches a sort of critical sandpile situation where this will lead to a sort of an avalanche of some sort within society as a whole. So the impact of this on the stock market is somewhat sort of indirect, but it's basically saying that there is a limit, there's a stretch factor that society will tolerate. And if you go beyond which, there's going to be some sort of reaction.
Mm.
If you move on to the next slide, Keith.
Actually, sorry, but Stuart, I'm
Yeah.
going to come in here because this is as an aside. But so my son had a letter published in The Economist this year
Oh, well done. Yeah.
about exactly this point. And his point was that Prince Harry was a very good example of Peter Turchin's elite overproduction. So he's he's a member of the elite, but he hasn't got a role. And so he's unhappy and is undermining the entire system.
Right, very good example.
Which is, I think, absolutely spot on.
Yeah. My chart here was just an attempt to look at the degree of stretch within US society. So the red line is GDP, the blue line is median wages, and it's really just emphasizing how median wages haven't gone up in line with GDP. And this is the point about the pump being taken control of by the elite. And it's that gap, that growing gap, that's the cause, Peter Turchin would say, of a coming dislocation. The surprising thing to me is that the reaction in the States so far hasn't particularly been about support for sort of Bernie Sanders left-wing type of solutions, but it's just as much supporting Trump. But you could say it's a general mass dissatisfaction with the system. It might be somewhat inchoate objections to the system, but it doesn't mean that it can't bring it down.
I agree. There's an article today in the FT talking about changes in society, particularly with regard to how people are living. So, 40 years ago, most people, so 40% of the age bracket 16 to 32 were living in their own homes, having bought their homes, setting up a new family. Now, the largest cohort are still living with their parents at that age. And the calculation for London, in order to afford a London house, the average worker would have to save for 30 years just to afford the deposit. And so the point of the article was that, Western societies work on this basis that if you work hard, you can have a decent life or a family in your own home. And actually, for the younger people, you just can't do that in London. It mystifies me how the London property market works. And I think the society is adapting, but the way it's adapting is kids are living longer than their parents, and then their parents are having to basically sell part of their own house or whatever, release equity to allow their kids to buy a house. But as you say, the danger is that everything seems to be working against young people, and at some stage, they rebel against the system.
Right, so moving from the somewhat theoretical and abstract to a few more tangible lessons from my portfolio from the year. Well, the first one is that I've been continuing to apply my reinvestment doctrine. A lot of my investment portfolio in my pension fund has got quite a high income level. And through the vicissitudes of the year, I just kept reinvesting the dividends. So it's in any particular month, it's not that large, but you get a sort of compounding effect and a pound cost averaging effect of even if you're just buying your existing holdings with the modest dividends. But when a rebound comes, as it did in November and December, you get a sort of boost, a compounding from that. Second lesson, as Keith has emphasized in many of the weeklies, equities are risky. There are so many risks out there. I held a small position in something called Home REIT, which was subject to a short seller attack. I was furious at this misinformation and this distortion from the short seller, who turned out to be completely correct. And it was a house of cards with homes for the homeless that have been bought at sort of double their real value.
Wow.
Where where the board just simply wasn't on the case of properly checking what assets it held and what rents it was actually receiving, rather than some vendor financing of a few years' rent, which had led them to think they were receiving rent when they really weren't. So that has now basically collapsed, and there's a legal case. Fortunately, it was a small position for me, but my goodness, that was painful.
Yeah, one of the lessons that I've learned over the years is that if a short seller becomes involved, just get out, because they've done the work. You haven't,
Yes, that's
actually.
so true. Yeah. A final lesson, keep the tax-related schemes simple. I've mentioned this on the show a few times, but I invested in a number of enterprise investment schemes and venture capital trusts. The venture capital trusts are just so much easier from a paperwork and liquidity point of view. I've got various enterprise investment scheme investments that are definitely worth more dead than alive. If only they would go dead, then I can claim that as a loss. But sometimes where I get statements back saying the directors are proving difficult to contact.
Really?
Yes.
My God.
So fortunately small, but I'm going to try to keep things very simple from now on.
Yeah.
So how was my performance last year? Overall, I was up 3.2%, so
Very
positive,
good.
but below inflation. So
Mm.
I've been losing track really. I think it's interesting that the split between income and capital return was a feature. My portfolio's got a yield of about 5.5%. So implicitly, I must have lost on the actual investments by about 2.3%, making that up via the income. So this is just the point about income and reinvestment each month, each quarter, just reinvesting those dividends and interest somewhere into the portfolio. So not a great year. And basically the cause of that was what we talked about on the show this time last year, the return of gravity, i.e. the
Mm.
increase in interest rates, which led to concerns that various of my real estate investment trusts would be finding it very painful when they refinance their debt. So their share prices weakened, and the general increase in yields led to weakness in the infrastructure stocks and green energy stocks and asset lending stocks that I own. To some extent, the profile of my performance through the year was very much like yours, Keith, but with a reduced amplitude. Uh,
Yeah.
because as interest rates were wanging around, hence I was up and I was down.
Mm.
So my positioning, well, it's not that much changed since I was last on the show. You can see here in the pie chart, it's pretty diverse. About 16% in cash, about 20% in REITs. So I'm continuing to have some infrastructure stocks, including I might add, because it was covered in the weekly. I've got some oil pipeline stocks, which
Yeah.
are not really subject to the vagaries of the commodity prices, but given the increase in US export volumes down the pipelines, they just take a toll on that. So I regard them as a sort of a decent sort of high single digit yield opportunity. I've got various wind and solar farms with via some UK investment trusts and some property-backed lending funds, a bit of gold, a bit of short-term bonds, and a bit of non-US equities in the proportions you can see in the chart, but quite diversified. And just to emphasize that those equities really are non-US equities, which is what's hurt me. And I've actually got quite a reasonable tilt towards emerging market and even frontier bets.
Mm.
Within the bonds, I've been trying to edge up my exposure to index linked, both UK and US, and I'm quite happy with my cash position. And in general, I'm trying to tidy up different aspects of my portfolio, single stocks, gradually easing them out and putting ETFs in. And as I previously mentioned, venture capital trusts, not enterprise investment schemes in the non-pension assets.
Any final thoughts, Stuart?
Well, I feel like it's masterly inactivity, but it's just not very masterly.
Well,
It
I
still
think
makes
that
sense to me to hold these positions. I'm looking to create a sort of high single figure return with not too many painful drawdowns. It's difficult. Am I being stubborn or am I being resolute? I'm trying to be independent and rethinking it every time, but I come back to wanting the stocks that I hold.
Yeah. Well, I think you've always had a very sensible and well-diversified portfolio, which will do well in the medium term. I constantly try and shoot the lights out, and occasionally it goes terribly wrong.
But overall, you've done well over the years.
I've done well over the years, and but going forward, I'm going to be really try and be less predictive. Actually, I'm going to spend more time either in a sensible portfolio or sitting in cash, waiting for something to turn up. And actually, when I look at what's happened this year, the volatility is such that, if you'd had the cash, you could have bought bonds at just astonishing rates. So, let's see what happens. But, we've got extreme valuations in stock markets, and, things swing around an amazing extent. So I think the one thing you can predict, I confidently predict, is more volatility for 2024. Okay. Thank you all for watching. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Stuart Owen.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.